What's up, YouTube? In this video, we're going to be covering the #1 mistake to avoid if you're thinking about using the backdoor Roth strategy. This video is going to be important for you if you're in a situation now where you make too much money to add money to a Roth IRA the regular way, and you're thinking about using the backdoor Roth. The mistake that we're going to be covering today is one I've seen very often over the years, and I want to make sure that you're avoiding it if you are going down this route. Quick introduction, if you don't know who I am, my name is Jose Hernandez. I'm a financial educator. I have a online financial education company that serves first-generation wealth builders, people like you and me, people the first person in their family to think about investing, and my goal is to help you learn how to invest for financial freedom and build generational wealth for your family. I started my career in the financial industry as a wealth management advisor, where I got my Series 7 and 66 licenses, and after some time, decided to branch off on my own and do exactly what I'm doing now, helping people across the world learn how to invest over the years, and super excited to be here for today's video. So with that out of the way, let's go ahead and get into it. We're going to be talking about, again, the #1 mistake to avoid if you're thinking about doing the backdoor Roth strategy, the backdoor Roth conversion, and we're going to go over some examples as well. So this is super clear. So in this video, like I said, we're going to cover the most common backdoor Roth mistake, which is the pro rata rule. We're going to talk about how the pro rata rule works, and I'm going to give you an example to make it more concrete. And more importantly, we're going to discuss how to avoid this mistake if you're thinking about going down this route. So section 1, again, the most common mistake to avoid if you're thinking about using the backdoor Roth conversion is falling victim to something called the pro rata rule. Now, this is a little bit confusing, to be frank, but I'm going to do my best to make this as plain English as humanly possible. So let's start off with the fact that when you have multiple IRAs, specifically multiple traditional IRAs, rollover IRAs, SEP IRAs, simple IRAs, and so on, the IRS considers you to have one big IRA. This is known as the IRA aggregation rule. So what that means is the IRS looks at all of your IRA balances basically collectively. So it doesn't really care if you take money out of one specifically. It looks at all of them together. And when this becomes an issue, specifically the pro rata rule, is when you have a combination of both after-tax and pre-tax money across all of your IRA balances. And if you've already watched the video on the backdoor Roth conversion, you know that part of that strategy involves you putting after-tax money into a traditional IRA and then converting that after-tax money to a Roth IRA. So therein lies the problem. If you have existing money in traditional simple SEP IRAs and that combination of after-tax money, this is where that pro rata rule can come into play. It's called the pro rata rule because basically the IRS assumes the withdrawal or conversion that you're making from collectively all of your IRAs is a combination of after-tax and pre-tax money, which means part of that conversion or part of that withdrawal is going to be considered after tax, which is not going to be taxable, but the other portion of it is going to be considered pre-tax. And as you know, if you watch the other video, whenever you either withdraw or convert money from a pre-tax account like a traditional IRA, that money is considered taxable as ordinary income. So to summarize section 1 of this video, really the pro rata rule comes into play because the IRS assumes you have one big IRA, even if you have separate, multiple traditional, simple, or SEP IRAs. And anytime that you withdraw money or convert money from any one of these pre-tax accounts, and you also have some after-tax money that has been or is in these accounts, the IRS is considering that withdrawal or that conversion to be made on what's called a prorated basis, meaning part of that withdrawal is pre-tax and part of that withdrawal is after-tax. And why this is a big deal, specifically with the backdoor Roth conversion, is if you watch the other video, remember, if we do the backdoor Roth conversion properly, we only pay taxes one time. And that's when you make the after-tax contribution to the traditional IRA. That money has already been taxed up front, similar to money that you put into a Roth IRA the regular way. Of course, we're having to do the backdoor Roth because we can't put money into the Roth IRA the regular way without being penalized. So the IRS doesn't care if you're like, hey, well, I actually took the money from this specific IRA that doesn't have any pre-tax money in it. It doesn't care. It's going to say you have money in all of your IRAs collectively that's pre-tax. So we're going to consider part of that money that you converted that was already after tax to the Roth IRA, we're going to treat it like some of that money was pre-tax. And remember, when you move pre-tax money to a Roth IRA, that money is going to be taxable to you as ordinary income. So said another way, the pro rata rule is an issue with the backdoor Roth conversion because you're essentially having to pay taxes again on money that's already been taxed. So in a nutshell, that's why the pro rata rule is a problem if you're doing the backdoor Roth, because you shouldn't have to pay taxes again on that money if you're doing the backdoor Roth conversion. We already pay taxes on the front end, and that money is after tax, so it should not be considered pre-tax. And this is why it's really important to understand the pro rata rule and how it works. So that's section 1. Let's actually talk more about in section 2 how the pro rata rule affects the backdoor Roth conversion and how that double taxation comes into play to make this a lot more clear. So let's go through an example together. Let's assume that at the end of the year, after doing a backdoor Roth conversion, that is, you have $93,000 in pre-tax dollars all across different IRAs, maybe it's simple IRAs, SEP IRAs, traditional IRAs, rollover IRAs. That's the balance that you have in all the other accounts that are pre-tax. And then you also did a $7,000 backdoor Roth conversion. So you had $7,000 in after-tax dollars that you contributed to a traditional IRA as step 1 of the backdoor Roth conversion. So if we look at this chart together, here's how the math works out. So essentially, the balance that you have in all of your IRAs, again, is $93,000 in pre-tax dollars. And the non-deductible or after-tax contribution that you made to the traditional IRA in step 1 of the backdoor Roth was $7,000. And that's also the amount that you converted over to the Roth IRA as a part of the backdoor Roth conversion. Here lies the issue. Even though that $7,000 that you put into the traditional IRA as step 1 of the backdoor Roth was after tax, because you're falling victim to the pro rata rule, what's going to happen here is the IRS is going to assume of that $7,000 that's after tax, really, they're going to consider $6,510 of that $7,000 to be considered pre-tax, which means you're going to get taxed on that amount, even though in reality, that's part of the $7,000 you already paid taxes on. So that $7,000 is already after-tax money. But because of the pro rata rule, basically the IRS is assuming, hey, part of that money is actually pre-tax, and you're going to owe ordinary income tax on that money, even though you already paid us in terms of taxes on that money. So here's how that math works out. $6,510 of that $7,000 will be taxed again, even though the original $7,000 that you did in step 1 of the backdoor Roth is after tax, because when we do the math, $93,000 plus $7,000 equals $100,000. $93,000 divided by $100,000 is 93%. So essentially, 93% of that $7,000 is going to be considered pre-tax, even though it's actually after tax. So what happens here is $6,510 of that $7,000 is going to be taxable again, even though you've already paid taxes on that money. Are you seeing the issue here? The issue here is, if you're not seeing it clearly, we already paid taxes on that $7,000. And in theory, we should have done this backdoor Roth conversion correctly to where there wasn't any gains on that $7,000, so we shouldn't have to worry about ordinary income tax on the conversion. But because we had pre-tax money in other traditional simple SEP IRAs in the tax year, because of that IRA aggregation rule, the IRS is going to consider part of that $7,000 to actually be pre-tax. And this is why the pro rata rule can be an issue if you're doing the backdoor Roth conversion. We should only be paying taxes once if you're doing this transaction correctly. So now let's talk about how to actually avoid the pro rata rule. Hopefully it's somewhat clear as to what the pro rata rule is and when it can apply. Let's talk about how to avoid this if you are a higher income earner and you're looking to do the backdoor Roth, but you don't want to get screwed on taxes. So by far the most important thing to avoid here is to do your best to avoid having any money in any traditional, simple, or SEP IRA by December 31st of the tax year in which you do that backdoor Roth conversion. Why December 31st? Well, that's the date that the IRS looks at your account balances in all of your IRAs to see whether or not the pro rata rule applies when you're doing that backdoor Roth conversion. So even though you did the conversion like in January, they're going to take a look at the balances on 12/31. So the key here is to not have any money in the traditional IRAs by 12/31 of the tax year if you want to avoid the pro rata rule on the portion of that conversion that was already after tax. And what a lot of my students, a lot of clients, a lot of higher income earners will do if they are in this situation where maybe you have a rollover IRA that has pre-tax money in it from an old 401k plan, what you could potentially do if your 401k plan allows for it at your new job is some plans do allow for you to roll over pre-tax IRA money into them. And the IRS does not look at qualified plans like 401ks or 403bs, for example, for the sake of the pro rata rule. So what a lot of clients, students, and higher income earners will do is they will make that move prior to doing the backdoor Roth conversion to make this as clean as possible. That way, by December 31st, the end of the tax year, there is no money in any traditional IRA, simple or SEP IRA, for the pro rata rule to even apply. So that's really important. That's a great way to avoid falling into this situation where you're having to pay taxes again on money that's already been taxed. And another option is sometimes if you don't have access to a new 401k plan, some employer 401k plans, if it's an old 401k plan, they may allow you to just keep the money in it. And that's another simple way to kind of just circumvent this entire backdoor Roth pro rata rule nonsense, is just to keep the pre-tax money in what's called qualified plans, 401ks, 403bs, which again, the IRS does not look at for the sake of the pro rata rule. So those are really the simplest ways to avoid it. The main key here is understanding that December 31st date and understanding the impact of having pre-tax money in these IRAs, and also understanding that the IRS doesn't care that you took the money out of one specific IRA because it looks at all of your IRAs collectively. So that is the pro rata rule in a nutshell. That is by far the most common and I'd say biggest mistake that I've seen people make when doing the backdoor Roth conversion over the years. And it's one that I want to make sure that you're avoiding if you're a higher income earner and you're in a position where you want to start doing the backdoor Roth conversion because you make too much money to put money into a Roth IRA the regular way. So hope you found this helpful. If you're in a situation where you feel like you're tired of not being sure about what you're doing with your investments, or maybe you feel behind the ball with your investments and you know you need to start taking this stuff seriously, but you need some help figuring this stuff out and making sure that you're on track, I'm putting in the description a link that allows you to schedule a one-on-one call with myself. That way we can have a further conversation, see what you're looking to accomplish, and see how I can help. So the link to that is in the description. If you found this video helpful, make sure to give it a like, subscribe to the channel, leave a comment. But that's going to be all for me for this video today. Hope this was helpful, and I'll see you in the next one. Thanks.